Hey folks, today I want to bring you up to speed on a few business owner-friendly ways to capture the education tax credits when you have children attending college or university. While this tax tip will hit our top priority of eliminating a tax due, there are enough limitations on these credits to make this credit limited for many of our self-employed clients or upper middle income clients. There are two credits available. The most lucrative, called the American Opportunity Tax Credit, is valid for the first 4 years of college or university for full-time students and is maxed out at $2,500 per year per student for the first 4,000 of qualified expenses. The second credit, called the Lifetime Learning Credit, has no limitation on years you can claim it, but it is capped at 20% of your first $10,000 of claimed expenses. Qualified expenses include tuition, mandatory enrollment fees, books, and required course materials. Otherwise qualified expenses paid for with non-taxable assistance such as scholarships or employer-provided tuition reimbursement are no longer eligible expenses. Room and board are not eligible costs either. The bigger issue in claiming these credits is the relatively low income threshold on parents claiming their college children on their tax returns. A single parent with income over $90,000 or a married couple with income over $180,000 has zero benefit from these credits. When a parent earns too much to receive the tax credits, our primary planning objective is to get the college-aged child on their own return and claiming themselves. However, with few exceptions, a college-aged child under 24 years old can only claim themselves if they can show they can earn enough money to support more than 50% of their food, shelter, medical, education, etc. When you earn too much money, we know of only two scenarios that would work to reach this goal. First, if you are a self-employed parent, consider an opportunity to hire your college child in your company. If we all feel like we can support the reasonable wage the child receives, we can accomplish two things here. We can shift expensive income from your high tax bracket to your child's very low tax bracket, and we can capture the $2,500 tax credit you would otherwise not be eligible for. Or the second option would be a fit for a parent with substantial assets, but who is not self-employed. If you gift sufficient assets to your child, assets that would represent the support you would be providing your child anyway, your child can sell those assets and use the proceeds to provide 50% of their support and unlock their own education tax credits. While this structure would be subject to what we call the kiddie tax, the education tax credits you would otherwise have been ineligible for can now be captured to pay the tax on the gains from the sale of these assets you would have otherwise had to pay. The point of this tax tip is to point out that if you earn too much money to qualify for the college tax credits, we may be able to advise you on a few options to help grab those credits for your use. Give us a call to talk more if these scenarios may be applicable to you.